Welcome everyone to Vested Interest. This is Shane back for another Stock Pick of the Day video. It is Tuesday, March 4th. We're going to take a look at Best Buy. This is out of the consumer discretionary sector. Before we get too far in the video, if you could do me a big favor, it takes only a couple seconds, but it really does help out the channel with the YouTube algorithm, help spread the word out a little bit more to people out there. Hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that subscribe button down below. Hit the notification bell so you're notified whenever I put out any new content. I do this Stock Pick of the Day video series Monday through Thursday. When the market's open, we take a look at a company's stock that's pulled back on the day, run it through the screener, see how it stacks up, and if it makes it onto my watch list. If it makes it onto my watch list, that doesn't necessarily mean I am buying. It means I am interested in doing more of a deep dive into the financials of the company and then working up a price for the company using a discounted cash flow analysis process Excel spreadsheet that I use. There's the thanks button down below as well for anyone that might find it in their hearts to buy me a cup of tea. So that's down there as well, and I really do appreciate everyone who's taken the time to do all that, and the viewers and the subscribers of the channel. You guys and gals are awesome. The channel continues to grow because of people like you. Now, this is the Vested Interest Stock Screener. You can pause this, read through it. You can tweak it, but it is just a screener. You know, if you want to use this as your own screener, that's fine, or kind of take it and make it your own, that's fine as well. But again, just a screener. Because it makes it to the screener does not mean I'm buying. It means I'm interested in doing more of a deep dive. Just an initial look on a high level. This does not really cover some of the financials you need to be looking at, their balance sheet, their income statement, debt to equity ratios. Is their revenue growing? Are they paying down debt? Do they have more assets over liabilities? A lot more you should be looking at. And if you're not willing to do those type of deep dives or don't know how to do them, you can still invest in the market. Just pick an ETF or an index fund. Track, say, like the Dow, the S&P 500 would be what Warren Buffett would recommend. So something like VOO or SPY that track the S&P 500, or one of the many other S&P 500 ETFs or index funds that are out there. You can look them up online. S&P 500 index fund or ETF. All right, now that we got that out of the way, let's get back to Best Buy. www.bestbuy.com is their homepage where I pulled this information from. That is www.bestbuy.com at the end there. So Best Buy, at Best Buy, our purpose is to enrich lives through technology. We do that by leveraging our unique combination of tech expertise and human touch to meet our customers' everyday needs. Whether they come to us online, visit our stores, or invite us into their homes, we have more than 1,000 stores and more than 85,000 employees in the United States and Canada. And Best Buy, a lot of you out there may be aware of them. They used to have what they called the Geek Squad, where you could get your computers set up. They have a lot of products inside of their stores, or you can shop online, right? The Apple products, electronics in general, TV and home theater, computers and tablets, all video games, appliances. So if you need a fridge or a stove, cell phones, audio equipment, cameras, home furniture equipment, they have a lot of other stuff. I think they even have yard and lawn furniture there as well. I don't think they have furniture, but more along the appliances, you know, washers, dryers, that sort of thing. But they are a big warehouse style retailer, right? They have physical stores, and then again, you can buy some of their stuff online. Again, www.bestbuy.com. That is their homepage. All right, the reason we are looking at Best Buy today, down 13.29%. That's a correction. Anything over 10% is a correction. 20% gets into a bear market territory. So right now, Best Buy is definitely in a correction, but not quite in complete bear market territory. If they drop below 20%, then they would be there. We are talking about Best Buy Corporation or company, ticker BBY, out of the consumer discretionary sector. Close up the day at $75.21. Looks like when I pulled this, they were slightly down a little bit in the after hours, though we got several hours left there. 52-week range as low as $69.29, as high as $103.71. They are within 15% of a 52-week low. Market cap of $16.08 billion. Beta of 1.45. So you can see this volatility throughout the day. They are more volatile than the overall market. One being the market, right? That's what beta stands for, the volatility of the market. PE, price to earnings ratio, is $12.88 per share. That seems pretty good for a company of this size. Earnings per share, EPS at $5.84, right? This is a pretty well built out company. Do they have a lot of room to grow? I don't know that they're growing stores like they used to. I think it's more maintaining their sales, right, from store to store now. Earnings date, they maybe even be closing some that aren't hitting their sales goals or are dragging them back a little bit, right? That's what companies like this will do. They'll start to close stores that are an issue. Maybe they're not getting the profits or the in-store sales that they need. Earnings date March 4th, so that was today. So I'm assuming something in their earnings report was part of the reason for this drop. Maybe part of what's going on with the craziness in the market overall has had something to do with it. But with them reporting today, I would definitely look at that earnings report if you're interested in this company. Forward dividend, $3.76 per year. So divide by 4 because they are a quarterly payer. That yield is 4.33%. Very high dividend yield currently. Ex-dividend date December 17th. Looks like they paid out on January 7th. So they're going to be paying out again in a couple, well, next month actually should be their next payout. So if you were to buy them now, you would get that next payout. I'm not sure what their next ex-dividend date will be, but they should be updating that at some point. 1-year target estimate, at least according to Yahoo Finance, $97.16. They don't see it getting back to its 52-week high from where it is currently, but they do see some upside as far as price appreciation. Jumping over to the right, I like to look at dividend yield theory, see if the company is potentially undervalued, again, based solely on dividend yield theory. This is just a quick check. 5-year dividend yield average of 3.59%. We compare it to the current 4.33, or over here where it says forward 4.33, same number, says forward there too. Same number, and since it is higher, their current dividend yield is higher than their 5-year average, that speaks to undervaluation on this one. Payout ratio, there's going to be a little bit of a discrepancy here. This is why I recommend more than one source. Yahoo Finance is calling it 64%, but we'll see with stock analysis a little later. They're saying over 80%. So I could go either way with this, and what you'd want to do when you see two conflicting sources or information from two sources that's conflicting, you want to go find a third source to verify. I did not do that. I just pulled the two sources, so I'm going to tell you right off the bat, they do conflict. Now, dropping down here, and depending on which one you go with, would add to the metrics that they either do or do not slide under, right? So looking down here at the bottom, I like growing free cash flow over time. Is typically if a company has growing free cash flow, they can do some things with that. They can pay down debt, make acquisitions, they can reinvest back into the company, buy back shares, which looks like they're doing, pay a dividend. This company does that and raise that dividend over time. But we want to marry that with the payout ratio, right? If the payout ratio gets over 75, and maybe yours is 60 or 65, then it starts to become an issue, and you have to start wondering, are they going to cut that dividend? But going back to free cash flow here, January 2022 here, you can see $2.5 billion in free cash flow. January 2023, $894 million. January 2024, $675 million. Trailing 12 months, $1 billion. Looks like they're repurchasing shares here as well. So cash flow is up and down, right? Actually a decrease over several years. Well, maybe not quite I would say decreasing from 2022 to 2024, increasing over the last trailing 12 months. Repurchasing shares, they're doing that, $3.5 billion in 2022, 2023, $1 billion, 2024, $340 million, trailing 12 months, continuing that trend at $355 million. Now, jumping over to stockanalysis.com, this is another source I go to for information, right? This is one of the two. That's why I recommend two, if not three, right? Two at a minimum, if not three, especially if you're getting conflicting data like we'll see here in a minute, then you want to go to that third source. 17 analysts have taken a look at this. They call it a consensus buy. Low estimate of $80. Currently sits lower than their lowest estimate. And if it came back up to $80, that would be a 6.36% increase in the stock price. Average estimate of $101.88 would represent a 35.45% increase from where it currently sits. And if it happened to hit their high of $117, that would be a 55.55% increase. And you could collect that 4+% dividend yield as long as they maintained that payout. Statistics here, I like to look at return on equity and return on invested capital. A lot of other good information underneath that tab. If you go to stockanalysis.com, you'll see it. Got their margins in there, revenue growth, EPS growth, a lot of other information in there. But right now, we're going to look at return on equity and return on invested capital. I like 10% or better, and return on equity, ROE, at 31.63%. Well above the 10% I'm looking for there. And return on invested capital, same thing, well above the 10% I'm looking for at 15.6%. EPS growth, earnings per share growth, I like 5% or better projected over the next 5 years. They're sitting at 29.44, so beats the metric I'm looking for there. And revenue growth is forecast at 2.27%. Now, keep in mind, a company like this is driven by sales. So if we had a downturn in the economy, this would be a company that would be hit, right? I don't think people are going to run out and buy a new computer if they can get by with the one they have, for example, or if you can get by with that. If your fridge dies, obviously you're going to have to because your food will go bad. But if you can get by a couple years, if it's just dented up or dinged up, or maybe there's a shelf broken or something, maybe you keep that for another couple years and don't buy that. Same thing with your washer. As long as it's still washing clothes, maybe it's making a lot of noise, but as long as it's making your clothes clean, you probably aren't going to run out and buy a new one until you absolutely have to, right? Whereas if the economy is going real good, and it's starting to make a noise, but it's still working, you might go out and get a new one if you've got the extra cash, right? Job's going good, you're not worried about it. That's the difference between a recession and good times, right? Whenever you're buying those things that you don't absolutely need, but it makes life a little easier, or maybe it just makes the headache goes away that it might go bad or it might break down, right? All right, but let's keep going here. So we've hit all that. Let's run it through this. Oh, one more. We got the dividend history here. Quarterly payout ratio, again, elevated. Stockanalysis.com has them at 87.85, right? Yahoo Finance had them in the 60s. So this is above 75. The other one was below it. This is where I would look for a third source. I'm going to go ahead and give them the check here, but if you wanted to take it away because they're saying it's 87.85 on stockanalysis.com and you trust stockanalysis.com more than Yahoo Finance, that's great too. But for me, these are two sources that I use. When they conflict, I go try to find a third. Dividend growth of 2.17%, so they are growing that dividend over time. Growth of 7 years. Buyback yield is positive, so they're buying back shares whenever they're relatively cheap. Shareholder yield positive of 5.8%. They do pay out off schedule as of most companies at January, April, July, October timeframe. Going back here, June 2022, they were paying 88 cents. March 2023, up to 92 cents. Raised it again March 2024, up to 94 cents. So there's that growth you're seeing. And I would say probably whenever they announce their next dividend raise would be in this March timeframe. That looks like whenever they are reporting those out, right, for the April payout. So we'll see. They haven't issued that report out yet. All right, let's check the screener. Understand the business. I've shopped at Best Buy, so I'm well aware of what they do, the products they offer. Maybe you have as well. They're a retailer. They have a lot of different electronics, like I said, washer, dryer, appliances, those sort of things. Your phones, you can get your phone there if you need to. Some other things in there as well. Growing free cash flow, no. Actually down for about 3 years, and then looks like maybe it's starting to turn around here this year. Growing dividend, or over the last trailing 12 months anyway. Growing dividend, yes, slow growth, a little over 2%, 75% or less. Depends on which way you want to go, and if you look at the third source, if anyone has, let me know in the comment section below. I gave it a check, but I could also argue that stockanalysis.com had them at 87%, right? Check valuation based on dividend yield theory. Dividend yield theory says they're potentially undervalued with a little bit of a margin of safety. It is within 15% of a 52-week low, so check there. Return on invested capital, return on equity, both over 10%, check there. Earnings per share growth was over 5%, almost 30%, so check there. So we're looking at 1, 2, 3, 4, 5, 6, 7. This does make it onto my watch list. It actually has been on my watch list for a couple of years now, and I just can't seem to bring myself to pull the trigger on this one. I just don't know that this company is growing enough for me to justify it. And then when I start to see the high payout yield or the high dividend payout ratio, 75, 65, 87, depending on which one you want to use there, it just gives me a little bit of the Leggett and Platt feeling, if you remember before they cut their dividend where they were at, or some of the other companies that have recently cut their dividends where they're paying a high payout ratio, or they're paying a high dividend yield, but their payout ratio is also very high with a very slow growth. So even if they maintain it, it's going to be slow growth. And I already have several in my portfolio that are like that. Verizon, for example. The only difference between Verizon and this company, in my opinion, is Verizon pays me a 6.5% dividend. This pays me a 4%. So I can deal with, around 2% growth from Verizon with a 6.5%. I don't know that I'm willing to take that on at a 4% dividend yield. That's the only thing that keeps me from really pulling the trigger on Best Buy. Let me know what you think in the comment section down below. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hit that subscribe button down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to cover in the Stock Pick of the Day video series, drop in the comment section. I'll try to work it into the rotation on a day it pulls back. I had to look at this one down almost 14%. I mean, that's a huge drop for the day. We've covered this one before on the channel. Like I said, it's been on my watch list for a while. But I just can't do it. Let me know what you think of Best Buy in the comment section. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Thanks for dealing with me rambling a little bit. Really appreciate all your support out there. And tune in to the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. Should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.